So in this lecture, we will talk about the basics of the options. And in the later part of the lecture, we will talk about how the options are actually priced. Let me share the screen. Okay, so let me first review some of the basics. So what are the option types? Option types are, in a big picture, there are two. So call option gives you the right to buy the underlying stock or any underlying financial assets. And put options gives you the right to sell an underlying asset. Now, when you exercise the options, so at what price do you sell or buy? That price is called the exercise price or the strike price. And what option gives you the right, and as in any other rights, there is an expiration date. So, the option is going to be in effect until the expiration. And in terms of expiration, there are two types. European options can only be exercised on expiration date, whereas American options can be exercised in any date before expiration. But once the expiration is passed, then the options are worthless. Now, option gives you the right, so it is not free. So you have to buy it. You have to purchase it by paying money. That price is called the premium. Option price is called premium. There are also other terms like in the money, out of the money, or at the money. So in the money options are the options where if you exercise it now, then you will make money. Out of the money options are options that are worthless if you exercise it now. And the at the money options are where the prices are exactly at the exercise price, so that you don't make, so that it's between the in the money and out of the money. So another review on the payoff of the call option. So suppose the stock price at expiration is ST, and the strike price is X, then the value of the call is given in the following way. So if the stock price at time t is greater than the exercise, then the payoff is simply ST minus X, right? Because it gives you the right to buy something. So when you buy, you only pay X because that's the strike price. And what do you get instead? You get the stock, and the stock value is ST. Therefore, your payoff to you is basically ST minus X. Okay, so this is the in the money case. Okay, well, in the next case where the option is out of the money, the option is out of the money. When does that happen? When the price and the stock price at expiration is lower than the strike price. In that case, call option payoff is simply zero. Put option is the other way around. Put option gives you the right to sell something at a given price. So if the stock price is lower, it is actually good. So suppose the stock price is lower than the strike price, then the payoff to you is basically strike minus S. And if the stock price is too high and higher than the strike price, then basically the put option payoff is zero. Okay. Now, the value of the call or the payoff of a call at expiration is given in the following way. This is what's called hockey stick because it looks like hockey stick. If the strike price is $100, okay, and you can plot the payoff with respect to the stock price. If the stock price is 100, then basically your payoff is zero. If the stock price, say, for example, is 120 and your payoff is 20 because the strike price is 100. Okay. The blue line here gives you the payoff. Because the options are not free, you have to pay the premium to get the options. And if the payoff is $10, then your profit should go down by $10, right? So there's a parallel shift of this hockey stick by $10 to the south. Okay. Now, value of the put at expiration or the payoff of a put can be drawn in a similar way. So we have stock price on the right-hand side and the payoff on the y-axis. Okay, and it's a put option. So when the stock price goes down, you make money. Okay, so because the strike price is 100, if the stock price goes below 100, then you begin to earn money, right? And how much? It goes along the 45 degrees line. Again, this put option is not free. You have to purchase it. Okay, what is the price? Price is $10 in this example. So your profit is actually, profit net of premium is basically the shift of the hockey stick to the south. Okay. Now, value of the short call at expiration is basically you flip the long position in a call. So in other words, short call meaning you're writing a call option, you're selling a call option to the other party, whereas the other party is the long side, right? So sometimes you call it short call or you write call, okay? So remember the hockey stick when the strike price is $100, looks like that. Okay, so I mean, this is 45 degrees line. This is 45 degrees. Now, when you short a call, basically you're in the opposite position of the person, of the other person. Okay? The other person who has the short, you have the long position in the call. Okay, so basically short call is this red line where you go, the payoff goes down by negative 45 degrees line as well. And you might wonder, well, it doesn't look very good because looks like you're always losing money, right? But that's not the case. Why? Because when you get into this position by shorting a call, what do you get? You get the premium from the counterparty, right? So you get $10 in exchange for these future payoffs. Now, let's take a look at a few option strategies. Options are useful for both speculation and hedging. Protective put is where you're using put options to protect your position. So this is like the insurance or hedging position. In other words, suppose you have the current stock price is 70. You're afraid that the stock price will drop. How do you limit your possible losses by trading options? What do? You purchase a put option. Okay, so in this case, you purchase an option with the strike price of 70. So what do you get? Okay, so you have a underlying stock. Okay, so this is a stock, the payoff of a stock, and this is the stock price. Let me redraw it. Okay, and you protect your position by purchasing an option with a strike price of 70. So this is a long put position. Now, if you sum the two, you have to sum it in a graphical way, then what do you get? You get the following, right? When the current price is, when the stock price is 70, okay, 70, then your payoff is going to be 70. Why? Because, well, if the strike, the stock price is 70, then your stock position is also 70, but your long put position payoff is 0. Okay, and then along when the stock price is higher than 70, it goes along the 45 degrees line, right? Because put option payoff is simply 0 in that region, whereas the stock goes up by 45 degrees line. Whereas when the stock price is lower than 70, basically your loss in the stock position and the earning from the put position are going to cancel. Therefore, you have this thing. Okay, so that is protective put. Even if stock price goes below $70, you don't lose money. And another common position is a covered call. So suppose you buy a share for stock price of 70, but then you're thinking, well, you know what? Microsoft stock has gone up a lot recently. Okay, so why don't I? So my view is that upside might be limited. Okay, so why don't I just take in some money by shorting a call? Okay, so you're shorting a call and also have a stock position. Then what happens? Well, in a short call, I'm sorry, the covered call position, this is what you do. Okay? So you have a stock position, okay, ST, okay? And you are shorting a call, right? So what is the short call position? I mean, this is the long call. Now, short call is basically the flip side of it. So it goes, it looks like this. The payoff looks like this, and the strike was 70. Therefore, what do you get? You get the following. It goes along the 45 degrees line until 70, and then it flattens out. So this is a covered call position. Another popular strategy is called the straddle or strangle. So how does that work? So straddle or strangle is basically you're betting on the volatility. So let's just focus on the straddle. In the case of straddle, you are getting into both the put and call positions with the same strike prices in the same direction. So what do I mean by that? Okay, so you long put with strike price of 70 plus long call with the strike price of 70, then you get this V-shaped payoff, right? So this is what's called a long straddle. Again, you might wonder, well, this looks just too good. You will make money always. Well, not necessarily. Why? Because when you are buying put and call options, what do you have to pay? You have to pay the premium. So this long straddle doesn't come for free. When are you going to make money with the long straddle? When the volatility goes up. So it doesn't matter whichever direction stock price goes. This is a direction neutral bet. This bet is direction neutral. Direction neutral, but it's a directional volatility bet. So it's betting that future volatility is going to be high so that your stock price goes up or down. It doesn't matter whichever direction it goes. As long as it deviates away from 70, it is good for you. So this is sometimes called long vol. I mean, vol is a short for volatility. It's a long volatility position. Okay? The opposite side of this is what's called a short straddle position. Here you short both the put and call. I'm sorry. Okay, so this is short put and short call, and then what do you get? You get this negative P sign. This is the infamous short straddle strategy. Okay, so in this strategy, you're betting negatively on volatility. You're betting that future volatility is going to be lower. Okay? When do you lose money? When the future volatility, of course, becomes very high. So there was a very famous case in 1995 where Nick Leeson, a trader at Barings Bank, basically blew up the entire bank. So he was betting on lower volatility in the future by shorting straddle. But then there was an earthquake in Japan, and he lost a lot of money for the bank, and which basically blew up the entire investment bank. Now we will move on to the valuation of options. Before we get into the quantitative valuation, let's take a look at the qualitative side. So call option value can be decomposed into two things. The first component is what is called the intrinsic value. Okay, so that is the value that you will actually get if you exercise now. This is the value you will get if you exercise now. So what is the intrinsic value of an out-of-the-money call? Is basically zero, because by definition, out-of-the-money call, if you exercise now, the value is zero, so the intrinsic value is zero. What is an intrinsic value of the in-the-money call? Well, there's going to be a difference between the stock price and the strike. Okay. And the question is the intrinsic value everything for the call option? In other words, is there some other value? Okay? That is called the time value. In other words, call option value, the market value of a call has two components. One is intrinsic value. The other is what is called a time value. In other words, which one is greater, intrinsic value or the option price? Option price is always greater because there is what is called the time value in a call option. Okay? So the difference between the intrinsic value and the option value is what's called the time value. By the way, this is not the same as the time value of money. So what is this time value? Time value measures the opportunity cost of the option, right? So suppose you have an American option, a stock price is very suppose you have an option which is out of the money. Okay? So call options say of strike price of 70, but the current stock price is let's say $50. Okay? What is the intrinsic value? It is the out of the money call, so the intrinsic value should be 0. Okay? But what will be the market value of the option? Is that going to be 0? No, it is not going to be 0. It's going to be a little bit higher than the intrinsic value, which is 0. Okay? Why is that the case? Because in the future, it is possible that the stock price, even though it is currently $50, it will be higher than 70. That opportunity, that possibility, is what is captured by the time value of the option. Now, we are going to value the option, and for that, we will bring in what's called the adjusted intrinsic value or the minimum value. Okay, so what is the intrinsic value? That is basically the exercise value discounted towards the current time. So what is the exercise value? That is the ST minus X. What is the present value of that? The future stock price, the present value of the future stock price is simply the current price, which is S0, and the strike price, you just discount it using the discount rate. Here we're using the continuous time discounting, okay? Continuous compounded rate for the discounting, okay? And then we define the adjusted intrinsic value as the maximum between 0 and this quantity here, okay? And it is known for a call option price that the market value is always greater than the intrinsic value of the call. So that the market value of the call is always above this adjusted intrinsic value. Okay? And this difference is basically what's called the time value of the call. Okay? Now, another important property about the call option, options in general, is what's called the put-call parity. Okay? So how can you understand the put-call parity? Well, you create a synthetic stock buying a portfolio of European call and European put and also risk-free asset. Okay? So how does that work? It is best to understand graphically. Okay? So what is put-call parity? Okay. The put-call parity is basically saying that you can synthesize a stock price, stock position using long position in the call, short position in the put, and a bond position. Okay. So how does it work? Well, so you want to replicate a stock payoff, right? And this can be viewed as the composition of the three things. The first one is the call option with strike price of S. Now let's add a put option with the same a short position in the put, okay, with the same strike price, okay? And the last thing you add is a bond. A bond whose face value is X, okay? So if you add the three things, basically you can see that these two quantities should be the same, okay? So the payoffs are always the same no matter what. Now, from the no arbitrage pricing argument, their prices should be the same as well, their prices. So this is the put call parity. In other words, stock price should be the same as the following: call price minus the put price plus the value of the zero coupon bond. Okay. So we get the put call parity like here. So let's take a look at this this example, right? So which of the following represents an arbitrage opportunity where you would do the following: buy the call, sell the put, sell the stock, and buy risk-free security? So you can see that basically this is a arbitrage strategy using the put call parity, right? So what is this strategy? You buy the call, okay, and you sell the put, and buy the call, sell the put, sell the stock, and buy risk-free security. Okay, here the interest rate is 0, so basically the risk-free rate, the risk-free security is just X. Okay, it is just X. Now, if for this to be an arbitrage opportunity, what should happen? The price of this thing should be negative. Why? Because we know from the put call parity, what is the payoff of this strategy? The payoff is always 0. Why? Because we know from, again, from the put call parity, the payoff of a stock is the same as this. Therefore, the payoff is always 0. Okay, so you're getting into some strategy. You're buying something, but that something is going to be 0 no matter what happens in the future. Are you going to pay any money? No. What should be the fair price? The fair price should be 0, but you want to make it an arbitrage opportunity. For this to be an arbitrage opportunity, the price should be negative. What's the meaning of negative price? You get this bundle, but you also receive money. Positive price means you have to pay something. Negative price means you are receiving money when you're getting something, right? So for this to be an arbitrage, this should hold. Okay? So in which of the, so what is the stock price? Stock price 110. This is 100. So we want to find the case where this is less than 10. Therefore, the answer is D. Now let's talk about the American options. American options, as I said briefly in the beginning of the class, it is exercisable at or before expiration. American options are usually the same as European option in terms of pricing, except when there's dividend involved, right? So we will consider the following two cases. American call option on a stock without dividends. Are you going to exercise it? Okay, that's the first question we will answer. And also American call option on a stock with dividends before expiration. Is it optimal to exercise before expiration? Okay. If I give you the answer first, if the stock doesn't pay the dividend before expiration, it is never optimal to exercise a American option before expiration. Now, if the stock pays dividends, you might want to exercise early. The reason is you want to exercise, get the stock, and take the dividends if the dividends are too large. Why is that the case? Now, there are reasons to exercise early and also reasons not to exercise only. Let's take a look at the reasons not to exercise only. Okay, so if you think of the option value, option value has two components, right? So there's a intrinsic value, and there's also time value, right? Let's consider the intrinsic value. What is the intrinsic value? Intrinsic value is stock stock price minus X times e to the negative RT. This is the adjusted intrinsic value. So why would you not exercise early? If you exercise early, in terms of intrinsic value, you are losing money. Why? Because suppose the exercise price is $70. Basically, when you exercise the American option, what do you pay? You pay $70. Suppose the stock price is, current stock price is 100. Exercise is 70. Okay. Now, if you exercise an American option before expiration, what do you get? You pay only 70. Instead, you get $100 worth of the stock. Well, it looks like a good deal, right? But it is not so good. Why? Because you are paying $70 of the exercise price now instead of later, because of there's interest rate cost. You don't want to pay $70 now if you can pay it in the next year, right? So because of the interest value of the call option, you don't want to exercise too early. Okay? So that's the first reason not to exercise early. There's another reason not to exercise early is because by exercising it, what do you lose? You lose the time value of the option, right? Remember, option value has two components. One is the intrinsic value, the other is time value. And if you exercise an American option early, then basically you lose the time value, right? Suppose the option is out of the money. You never want to exercise now because of time value. If you wait out, there's some chance that stock price is going to be even higher. And so there are two strong reasons not to exercise early. The first is in terms of intrinsic value, you lose the interest value for the exercise price. Second reason not to exercise early is because you lose the time value. Okay? But however, there are also reasons to exercise early. The first case is the put option. Okay? For the case of the put option, it's the other way around because you are receiving the strike price. Okay? Suppose the strike price is 70 and the current stock price is 50, right? By exercising it now, you receive $70 now instead of 1 year later. Okay? So you get the interest value on the $70. So you might want to exercise early for the case of the put option. Another reason to exercise early is the dividends. Okay? Now, if you consider all these things, for the put option, it's not really clear whether you have to exercise early or later. Why? Because you exercise early, you lose time value for the put option, but you also take the interest value for the put option as well. So for the case of the American put option, it's not really clear whether you have to exercise early or later. But for the case of the call option, it is clear. When there are no dividends, there are no reason to exercise an American call option early. Okay, so in the absence of dividends, it's never optimal to exercise call options early.